Okay, welcome everybody. Thank you for taking time out of your day to join me for our 2021 Q1 market update video. I want to take a quick moment just to set the stage of what I'm going to be going over. First off, I'm going to be giving an overview of what the first quarter 2021 entailed, covering what is going on with the bond market, also with inflation. We'll also cover the current state of the vaccines, how the markets have fared during the first 90 days of the year. And then we'll give you a quick summary on our investment philosophy, some of the previous buys and sells that we did over the past quarter. And then we'll finish off with some updates on how our investments have performed. So of course, before I talk about anything investment related, I do need to give you my obligatory disclaimer, like I typically do, is of course, investing in anything can be potentially risky. And of course, this video should not be considered to be advice in any way, shape, or form with regards to the investments. This is not taking into account any individual's risk tolerance or suitability. Of course, before you ever buy any investment, you should always be mindful of whether or not this is the right fit for you. And if you're ever unsure, then that's precisely why you should consider speaking to a professional. Let's get into the Q1 recap of what actually went down. By now, you've likely noticed that the cost of goods like gasoline, lumber prices have all gone up. And this is what we like to refer to as inflation. So during the entire pandemic, the savings rate, frankly, across all of North America has hit all-time highs for those who are gainfully employed during that period. And now people are spending that money that they saved like gangbusters. But there are shortages, unfortunately, everywhere as the supply chain didn't actually keep up with demand. So to combat this, the government has actually started to raise interest rates. If you have any variable rate debt, like credit cards, lines of credit, or variable rate mortgages, you're likely aware of how much interest rates have actually increased over the last little while. For bond investors, as bond yields go up, the prices of the bonds actually go down. This means fixed income investors could be facing a really tough time going forward. Okay, so let's take a step back and look at the markets overall. I'm going to get deep into the weeds a little bit later on how we've done specifically, but I want to take a step back and talk about how the markets have globally done over the last little while and how they fared, frankly, in the first quarter. So to date, the Japanese stock market has actually been leading the charge. They've done an astonishing 9.3% return during the first 90 days of 2021. So outside of the United Kingdom, European nations have also done very well. The MSCI Europe Index is up almost 8% on a year-to-date basis. The S&P 500 is up nearly 5.2%, and the Canadian TSX is up 7.3% as well, which is great to see. Okay, so let's take a step back and talk a little bit about vaccines, because of course, we can't go 2 minutes without talking about COVID. Okay, so to date, over 1 billion doses of the coronavirus vaccines have been administered. Over the last 12 months, there are nearly 230 vaccine candidates that have entered into the approvals pipeline. Currently, there are 13 vaccines that have been approved for use around the world. Now, leading the world in both doses given per 100 people and also share of the population that have been fully vaccinated is Israel. And I have to say that it's not even close. They are leading the charge by a landslide. The United Kingdom ranks 7th, Denmark is 14th, France is 24th, Poland is 36th, Brazil is 41st, and all the way down, unfortunately, in the 53rd spot is Canada. Now, countries like Romania, Portugal, Cyprus, Russia, Colombia, unfortunately at the moment all rank slightly higher than Canada, which is only fully vaccinated about 2.7% of its population. Okay, so a little bit of an update on the coronavirus itself. I want to echo on a point that I made in my last quarterly review video that the vaccines are here and the world is opening up, but there's still a lot of work that needs to be done. Again, to reiterate, to date, over 1 billion people around the world have been vaccinated. That's nearly 32% of the North American citizens have been vaccinated, 5% of Europeans, 14% of those in South America, and nearly 5% of those in Asia. And I know that Asian number seems low, but you have to remember that nearly 60% of the world's population lives in Asia. So to date, 161 million people worldwide have unfortunately been infected with the coronavirus, representing nearly 2.1% of the entire population of the globe. The deaths have also unfortunately ballooned to over 3.2 million. They were only 2.2 million when we ran these numbers last quarter. So unfortunately, that's been a big uptick that represents about 33% increase in the last 90 days, and that's shockingly high. Nearly 4% of Canada's entire population has been infected with the coronavirus, which fails in comparison to the whopping numbers out of the US, which is nearly 1 in 10 people across the country have actually contracted COVID. Let's take a wide-angled look at the daily case count around the world. Obviously, as they've ramped up testing, case counts will continue to increase. Remember that at the beginning of the year, when cases were dropping like flies, well, don't hold your breath now because they actually hit an all-time high recently. These numbers are global in nature, so they might not tell the whole story about what each individual country is going through. But for example, while the daily case numbers in the US continue to decline as they ramp up their vaccine efforts, countries like India are seeing case counts hit records every single week. Okay, so let's get into a market recap and recessionary checklist that I like to do every single quarter. So 2021 was off to a great start. Biden was sworn in as the 46th president of the United States and immediately started to take action. The president's $2 trillion infrastructure recovery package, which aims to revitalize the United States transportation infrastructure, water systems, broadband, and manufacturing, among other goals. With the markets pricing in this reopening of the economy, nearly every index was positive through the first 90 days of 2021. The S&P 500, despite the sell-off in technology names, traded up about 6.2% to a record high in Q1. The MSCI World Index also hit a record high of about 4.5%. Now, the MSCI Emerging Markets Index was up about 2.3% on strong capital inflows. Here at home in Canada, the S&P TSX Composite Index also performed well, climbing 8.1%, just short of the record high. So this was led higher by healthcare and energy. So now on the fixed income front, with the surge in interest rates, yields on the 10-year treasuries ended the quarter about 1.74% up from 0.93% on January 1st. During that same period, the yield on the 10-year Canadian bonds moved from 0.81% to 1.55%. These are massive swings in very short periods of time. I just have to say that out loud. Overall, in this bearish yield environment, we preferred the risk profile of equities over bonds. So, of course, with the rallying in yields, bond returns were negative for the year on March 31st. Now we're going to take a step back and look at three major indices, the S&P 500, the TSX, and the MSCI World, along with the 10-year Canadian and US bond indices, and of course, let's not forget gold. So as you can see, there's been a clear divergence between risk-on and risk-off asset classes. When I mention risk-on, I'm referring to the equities indicated by the black, red, and green lines. When I'm mentioning risk-off, I'm referring to bonds and gold indicated by the pink, gray, and yellow lines. You can see this by looking at the pink and gray lines representing the Canadian and US 10-year bonds. Gold, another risk-off asset, saw a large loss throughout the first 90 days of the year. Canadian and US international equities, on the other hand, had a great first quarter. Okay, so getting into our recessionary checklist, what a difference 90 days can make. During the last quarterly update, while indicators around the world were improving, most still remained in cautionary territory, as the world struggled to get out of the depth of last year's recession. This quarter, nearly every indicator we followed has improved. This is exciting for us as global investors. So let's focus in on Canada a little bit here. The IV Purchasing Managers Index, which gauges the confidence of businesses in Canada, jumped to its highest reading since March of 2011, the second highest since the survey began in 2000. This points to strong improvement in economic activity. Unemployment, while down from its peak of around 13.7% in May of last year, still hovers at around 8%. Housing starts in Canada surged to 21.6% over a month earlier as a record high of 335,000 units. So a supply imbalance has been blamed for the skyrocketing home prices throughout the pandemic. Though new listings surged in March, which coupled with strong starts suggests that a more balanced market could be coming in the future. Here's to crossing our fingers on that one. Anybody trying to buy a house. In March, bankruptcies in the United States fell to the lowest level since 2006, suggesting that the reopening of the economy is in full swing. While the US has fared better at getting people back to work, their unemployment rate still remains at levels not seen since 2014. The unemployment rate in the United States still stands at about 6.1%. Similar to Canada, housing starts in the United States have exploded and are now near levels not seen since 2006. A recurring theme, inflation has taken hold in the United States and is now approaching 2008 levels. This is something, again, we're watching very closely. Okay, so now from a global perspective. Business confidence in Europe hit its highest level since 2019. As far as global bankruptcies go, European and Japanese companies have rebounded nicely from the depths of the COVID recession. As you can see, the business indicators across the board have shown significant signs of improvement. And again, this is very promising from an investment point of view. When confidence is high, companies increase their plans to invest and expand their businesses. And then, of course, this increases their output and supplies and ultimately job growth. In China, most indicators have remained unchanged since last quarter, with the exception of consumer confidence, which has now hit an all-time high. Unemployment in Japan has moved up from warning territory into caution territory. Combined with the fact that the housing starts just hit a two-year high, the Japanese economy is clearly rebounding after last year's pandemic outbreak in March. Okay, so let's switch gears a little bit here and talk a little bit about our investment philosophy. In today's world of investing, there's a tremendous amount of noise that exists, from endless amounts of financial magazines, TV shows, fake news, political propaganda, and social media. There are headline feeds which are inundated by a constant flow of information. Some of it important, most of it unfortunately pretty useless. And to complicate matters further, we all have biases and personal beliefs that can often cloud our own investment judgments, especially during times of high stress, such as experiencing a big market crash, or euphoria, such as earning a big return on any investment. After poring over numerous investment research papers and testing a variety of different investment models, some based off of instinct, others based off of data, we concluded that the best approach to achieve consistent long-term success is to take as many of the human emotion element completely out of the equation. This has led to us developing an investment model that utilizes pricing data to take advantage of strong uptrends in different markets around the world, while also managing risk in an extremely thoughtful manner. Okay, so let's get into what we bought and what we sold previously. Okay, so now let's dial into what we have bought and sold previously. Now, of course, remember my obligatory disclaimer. If you missed it, please scroll back or check out the one that's at the end. But of course, this is not to be considered to be advice. This is literally just going over what went in and out of the portfolio over the past quarter. So I'm going to take a moment to discuss some of those, and specifically let's dial in, at least for starters, into our sustainable equity strategy. Now, our sustainable equity portfolio invests primarily in North American equities, and of course, these have a lens of sustainability attached to them as well. Okay, so some of the major purchases that we made during the first 90 days of 2021 would include, number one, Texas Instruments. Now, Texas Instruments, for people who aren't familiar, trades on the NASDAQ. It is one of the top 10 semiconductor companies in the world. You likely know them as investors, at least by being one of the world's largest calculator manufacturers. At least that was what I remember them from. Throughout the first 90 days of 2021, Texas Instruments was up nearly 16.5%. Okay, another company that we had bought in earlier in the year was Johnson & Johnson. We started buying J&J in January, and it's been one of the largest positions in our equity model since that point. Now, Johnson & Johnson was a little bit stubborn and has been a difficult position for us to stomach given what we thought it would end up doing. Now, we had expected, based off of momentum, like I previously discussed, a nice pop in the stock on the basis of the vaccine rollout, which of course didn't end up happening. So that being said, Johnson & Johnson has still provided us with a big amount of stability in the portfolio and has actually been up about 5% over that time period. Now, another company that we've bought was 3M. And 3M is a massive company that produces literally over 60,000 products, including Post-it notes, Scotch tape, bandages, and of course, many PPE devices. We started buying 3M in February and held it throughout the quarter. Throughout the first quarter of 2021, 3M was up over 12%. Now, another company that we added earlier in the year was Expedia. Now, Expedia is one of the reopening stocks that we really liked. It was up over 31% in the first quarter, and we started buying Expedia towards the beginning of Q2. So another company that we sold was Constellation Software. After briefly owning CSU in December, we ended up selling it before a nearly 6% decline in early January. Now, while it rebounded in February and March, it did not match the risk and reward ratio we were seeking for a lot of our investments. Now, CSU is a great firm, and we likely will be back into the portfolio at some point in time, but for the time being, at least over the end of the first quarter, it was something that remains on the sideline. Now, another one was NVIDIA. Now, NVIDIA is a stock that we've held since November of 2019. We're turning over 163% for a lot of our investors. But as you know from a previous section, our investment selection is really all about momentum. And since September of 2020, NVIDIA has actually been basically flat. So we've actually taken a lot of our profits from NVIDIA and moved them into a lot of other positions. So another position that we trimmed was Colgate-Palmolive. Now, this is trading on the New York Stock Exchange. Colgate-Palmolive, owns brands like Speed Stick, Colgate, Sanex. We've owned CL throughout January, but sold it in February, finishing Q1 down about 6.5%. Again, Colgate-Palmolive was one of our pandemic plays that performed very well last year, like I previously mentioned, but we're making a shift into some more reopening oriented stocks like those of Expedia, like we mentioned previously. Another position that we ended up trimming was Ritchie Bros Auctioneers. This is one of our favorite stocks last year, as it transitioned its auction houses very well to pretty much 100% online. But since mid-2020, the stock has been flat. As trend followers, the last thing we want to do is tie up capital in a stock that's going nowhere. So as of February, we no longer own the firm, and it's actually been out of our equity model. Okay, so now let's switch gears and focus on our Canadian and US dollar ETF portfolios. And some of the major purchases that we did in the first 90 days include frontier and emerging market stocks. So let's first clarify what frontier and emerging markets mean. Frontier markets are countries that are less established than emerging markets because they're frankly too small or carry too much inherent risk or are too illiquid to be considered an emerging market. Some examples of frontier countries are Argentina, Slovakia, Lebanon, Vietnam, Sri Lanka, just to name a few. Now, an emerging market is a market that has some characteristics of a developed market, but do not fully meet the standards. This includes markets that may become developed markets in the future or were at one point in the past. Some examples are Brazil, India, China, Turkey, and Russia. Now, we primarily use ETFs to gain exposure to these types of investments. Okay, another theme that we were looking at was e-gaming and e-sports stocks. One of our newest additions to our Canadian dollar and US dollar portfolios is a play that taps into the exploding market that is esports and e-gaming. Now, many of us are familiar with the rise of video games amongst our youth and even today, but what very few people know, there are figures behind this growth. We all know how big music and the film industries are. Now imagine taking them, combining them, and then multiplying them by 250%. Now that's the size of the esports and e-gaming industry today. This is an area that we really like on a go-forward basis. Another theme is European stocks. Now, to gain access to European stocks, we use the XEH ETF in Canada and the HEZU ETF in the United States. And as you may remember for our recessionary checklist, virtually every European indicator has improved over the last 12 months. Now, the European Central Bank President acknowledged that the Eurozone and the US are on different pages when it comes to the economy, and they're also their inflationary outlook. And basically, the ECB would not be acting in tandem with the Fed. Now, another theme that we've been looking at is mortgage and real estate stocks. Now, in March, for the first time over a year, we've actually started to move back into domestic and international real estate and mortgage corporations. Now, we typically access these through a variety of securities like Firm Capital, USRT, and VNQI. Now, real estate generally has provided investors with solid protection against inflation. And as previously mentioned, at a 12-year high in the United States, inflation hedge investments are typically assets that are expected to increase or at least maintain its value over a period of time. This plays into three aspects that make real estate a great tool to fight inflation: appreciation of value, increasing income through rent, and depreciating debt. Now let's look at some major sells that we made during Q1 in our ETF models. We started liquidating our positions from emerging market bonds in both our Canadian and US dollar ETF portfolios. Rising interest rates around the world have created a massive headwind for us in Q1. And we've become much more focused on our bond positions, going from 11 positions in November down to only 5 positions in March. Another one that we trimmed was short-term bonds. Once again, no surprise here. As interest rates continue to march higher, we're extremely thoughtful about our fixed income exposure. As of the end of March, we have completely sold out of our short and intermediate term North American bond positions. So here we're looking at our performance of our portfolios, and our ETF models have done extremely well throughout the year, really holding their own in pretty much against every major indice. Our sustainable equity strategy has lagged a little bit at the beginning of this year, again, largely due to some of the exposures that we had in technology and how, frankly, tech stocks have really taken it on the chin after having a gigantic run-up last year. This just goes to show you how rotating your sectors is super important. We've already repositioned the portfolio as I've previously talked about, and again, over the next quarter, we'll see how that pans out. So as always, I really appreciate you taking time out of your day to join us. The purpose of this outlook is really to give you a very thorough, detailed analysis as to not only what we've done, but how we think, and more importantly, what's happening in the world right now. We really appreciate the trust and the faith that you do put in us for those of you who are our clients. And hopefully this gives you greater insight into not only what is going in, what's going out of the portfolio, but more importantly, the big picture. Because again, like I've always talked to you all, putting things into context is extremely important. And one of the things you want to be aware of and mindful of is not just how are we doing relative to what any major index, pick one, people do this all the time, but I also like people to always focus in on how are you doing relative to where you need to be, and taking a very plan-based benchmark approach as opposed to just comparing it against any index. Mostly because you want to make sure that what you're doing is relevant to you and relevant to your life. So happy to answer questions that you guys might have. Please feel free to fire me off a direct email. I'll put my contact information at the end. And of course, I do appreciate it. And until next time, stay safe out there, everybody, and we'll talk to you soon.